Hey YouTubers, welcome back to my channel. For those of you that are new here, my name is Sai. And in today's video, I thought I'd talk about how to pick an investment company to add to my stock portfolio. I mean, everybody has their own analysis and different ways to decide what works best for them. But I thought I'd give you an insight of what my thought process is. But as always, I have no financial background whatsoever. So before you go and invest in anything, I always recommend that you go and seek professional financial advice. But while you watch the intro video, make sure you smash that like button and turn it blue so you can help the YouTube algorithm recommend this video to lots more people. So, buying into an investment company is just like investing into, say, a car or a house or something else that is of significant value. Now, the only difference is that you can actually buy shares in stocks at a minimal price these days. So, on a really high level, one thing that you should always do before spending a significant amount of money is research. So, first thing is understanding your personal constraints. How much are you able to invest? And what do you want to gain out of the purchase? Then you consider looking at what to buy and analyzing the different options and their price and looking at the history of the item. And then eventually, the more you do this process, the better you get at identifying the benefits and the gotchas. So just like buying something of significant value, the same process should be applied to buying stocks. Now, this is the same advice if it's a single investment into a company or even if it's a diversified index fund. And just like buying a car or a house or any other expensive item, there's nothing out there that can give you 100% certainty that there'll be no problems once you bought it. But you can do your own due diligence to minimize the risk. So first of all, making a plan. It's like what Abraham Lincoln said. If you give me 6 hours to chop down a tree, I'll spend the first 4 hours sharpening the axe. And I guess while I'm quoting quotes, there is that famous one of a goal without a plan is just a wish. This is why planning is so important, as it actually drives you towards the end goal. So as part of the planning process, you need to identify how long you want to keep an investment for and how much risk that you're willing to take. Now, for instance, if you're investing because you need money in the short term to pay off a credit card debt or a loan, etc., investing in the stock market is a little bit too risky due to the volatility of the market, as stock prices can fall very quickly, therefore leaving you at a worse position than where you were before. However, on the flip side, the history of the stock market proves that investing in the stock market over a long period of time, usually about 10 years or more, generally reduces the risk of loss, making it a great option for aiding a long-term investment goal, such as buying a house or planning for retirement. But like Warren Buffett has said, in order to do well in investing, you need the right mindset, as you need to be able to accept the dips in the market with the knowledge and trust that the markets will rebound and get better again in the future. Now then, there's the other part of planning when it comes to investing, is knowing how much risk that you're willing to take. Therefore, knowing how much of your portfolio you will allocate to each type of investment. Now, all investments have a level of risk, but the risk generally increases when the potential of returns also increases. Now, that's why most investors usually allocate a significant portion of their portfolio to typically lower return investments, such as bonds and ETFs, in order to help balance out the potentially higher return investments. Now, the thing to think about when purchasing any high value item in your life is doing the research to know what the options are. So just like buying a car or a house, there are many different styles, types, and other factors that can affect your decisions in buying one. So when it comes to the stock market, you may consider the market cap of a company, what sector it belongs to, or whether the company pays out a dividend, etc. So here are a few things that I like to look into. So first of all, the sector. Now, every company falls into a type of industry, which in turn falls into a sector. Now, for example, a bank would be part of the financial sector, And an internet company will be part of the information technology sector, and pharmaceutical companies will fall under the healthcare sector. Now, typically investing in different sectors helps to diversify your portfolio, as usually when one sector does well, there's other sectors that are also doing badly, therefore allowing yourself to balance your portfolio. Now then there is the type of stock that you want to buy. For instance, do you want to buy a brand new car or a new build house? Or do you want to do some extra work and find a bargain stock that may have been overlooked? Now there are usually two categories when looking into the type of stock you want to buy, and that's a growth investment stock or a value investment stock. So with a growth stock, this could be a company that is growing rapidly or has had a lot of media coverage that considers them to be a disruptor. Whereas a value investment is usually when a company seems to be undervalued. Now obviously both have their own benefits and risks, and so once again it's so important to have a mix of both to help diversify your portfolio. Now, when going stock shopping, the value that most investors look at with regards to the size of a company is their market cap. Now, this is basically the value of the company when you take all the number of shares that a company has and then multiply it by the stock value. So for instance, Apple have 17.1 billion shares and they are currently trading at around $116. So when you multiply 17.1 billion by 116, you get just over $2 trillion. Now, a small cap company is usually a company valued between $250 million to $2 billion. A mid-cap company is a company valued between $2 billion and $10 billion. And a large cap company is one that's valued at over $10 billion. So when looking at the size of a company, people usually look at them in two different ways. Either the current value of the company as it is, which usually stands for older companies that have not grown much in the last few years. Or then you have people who look at the potential of the market value based on the popularity and market sentiment of the company, thinking that the company has a potential to grow further in the future. This then makes large cap companies more stable and less risky, and making low cap and mid cap companies more riskier but have more chance of growth. Now usually the large cap companies are more likely to pay out a dividend as well, which brings me on to the next aspect that I like to look at, and that's dividends. So as a stockholder, you always expect to make money in two ways. Now, one is the company's stock price going up in value, and the other is a way through dividends, which is basically a portion of profits that the company pays out to the shareholders. Now, not all companies pay dividends, and they're not always guaranteed with the companies that actually do offer it. Also, the companies can just stop the dividends at any time or reduce them without any notice. But investors who focus on dividend stocks usually try to invest enough so that they end up generating another source of income. Now, one of the key terms to look out for dividends is the dividend yield, which tells you how much the company paid in dividends in that fiscal year, divided by the company's share price. Now, when I usually buy a dividend stock, I would make sure that the dividend yield is at least 4% if I'm buying the stock in order to increase my dividend portfolio. Now, most investors don't actually take the dividend payout from their portfolio. Instead, they usually reinvest the payout to buy more shares or fractions of shares. Now, the other aspect I look at when preparing to buy a stock, whether I want to buy an individual stock or a fund. Now, as there are thousands of individual stocks to choose from, it can get a little bit daunting. So sometimes it's a better option to buy into an ETF, an exchange traded fund, or an index. Now, this basically allows you to own many stocks at once, which helps to reduce the risk of picking just one stock and provides you with that all-important term I keep using, diversification. But with ETFs and indexes, you can also find funds that are focused on specific sectors as well. Now, for most beginner investors who don't have time to do their own research, it's been proved time and time again that by investing in well-known funds such as the FTSE 100 or the S&P 500, investors have been able to essentially beat the market because the annualized return on the S&P 500 over the last 90 years has been on average around 10%. Now, once you've decided on how you're going to invest, now the next part is to actually research and analyze the stocks that you are going to buy. So buying a stock means you're becoming a part owner of that company. So of course, you want to buy into a company that is well managed and profitable, and you obviously want to get a good deal in buying into it. So in order to find this out, we need to check out the financial situation of a company. Now the information is all public, as the company is publicly traded. Now you can usually find all this information on the company's investor related website, or most of the information is also surfaced on the new trading apps such as Trading 212, which is what I use. By the way, if you haven't got a Trading 212 account yet, use a link in the description down below to go and create your own account, and both you and me can get a free stock worth up to £100. So the key things to check before buying a stock. One of them is the company's revenue. Now this helps us understand if the company is growing or not. So the revenue is the total amount of money that a company generates from the sales of goods. But what's even better is being able to see whether a company has been increasing value for net worth, as the net income is telling us how much the company is making minus the expenses. Now the next thing I usually check is how the company is earning, and we do this by checking the EPS value, which is the earnings per share. This is basically the company's earnings divided by the number of shares it has in the market. So if this value is in the positive, this shows that the stock is healthy and makes it a potential opportunity for investors. Now the next thing I like to check is to see whether the stock is fairly priced or not. Now this is when I would look at the PE ratio. This basically tells me what investors are paying for the stock in relation to how much the company is actually earning. So for instance, with Apple, the PE ratio is 39.36. This means that investors are paying $39.36 for every $1 that Apple earns. So a high PE ratio usually means that investors are expecting higher earnings, but it could also mean that the stock is overpriced. Now a low PE ratio can indicate that a stock is underpriced, or the company has limited prospects. Now, sometimes I also check the price to sales ratio, as this is where the company's stock price is compared to the company's revenue, which is in essence their sales. This is done over a specific period. And as we can see here in Apple, they use the last fiscal year and a trailing 12-month period to show the measurements. Now the reason why this value is useful is because you can compare this ratio between companies in the same industry and ultimately get a sense of which ones might be undervalued or overvalued. Now for example, if the top 3 companies within the tech sector had a PS ratio of 3, 5 and 7, then you can tell that the company with the lowest PS ratio is likely to be undervalued, as its sales are high in relation to its share price. So then after these checks, I would then see if there are any red flags on the financial reports of a company. And this is where I look at the debt to equity ratio. So it's normal to have some debt, but if a company has an abnormal amount of debt, it's definitely something to dig into a little bit deeper. And this is where the debt to equity ratio helps. Now, I usually tend to use this measurement when I don't know too much about the company itself, as a lot of the large tech companies that I normally follow, I already know that they invest heavily in manufacturing. Therefore, their debt is usually quite high, even if they are as cash rich as Apple, for instance. Now, the DE ratio measures the total liabilities of debt of a company and divides it by the shareholders' value. Now, if there's a ratio of 1 or lower, this usually means that the company can cover its debt if it had a bad year. But if a company has a high DE ratio, this could end up being a sign that the company is way over its head. Now, I usually use the website Macro Trends to check the DE ratio. Macro Trends also lets you see lots of other metrics that can be really useful as well. Now, obviously, one of the key things everyone wants to know is if they are getting a good deal with the stock that they are buying, which is where we then look at the return on equity, which basically tells you how well a company is turning its equity into profit. Now, by knowing how much a company earns per dollar of value that the shareholders have invested into the company, this gives you a good indication of whether you are getting a good deal or not. And of course, the best way to check is to compare the ROE against other similar companies. Also, it's good to check the ROE of a company's previous year, or even better, Trading 212 provides a 5-year average. Now, with all the ratios mentioned in this video, I always like to compare them with similar companies in the same sector. And then on top of that, also do some research on the company as well, to understand what the company's goals are for the future, and understand if they have the opportunity to thrive or not with the ever-changing world ahead of us. And in some cases, this may even require just watching the stock fluctuate for a time period in order to understand how it reacts to the economy. But essentially, it comes down to the fact that there are a lot of moving factors that can make a stock seem desirable, but there is always a risk involved. And so in order to minimize the risk, research is a requirement. Well, that's it for today's video. I hope you found it interesting. And I'd love to hear from you the metrics that you use in order to choose your stock. So head down to the comments down below and leave a message for me. And if you haven't already, make sure you subscribe to my channel and click on the bell so you get notified when my next video comes out. And as always, make sure you like this video, comment down below and share with your friends and family. See you in the next video. Bye.